Welcome to what I call the deep dive video, and I want to explain this right off the bat. Every week I do a number of different videos. I do a weekly video, I do an intermarket analysis video, I do a video each day. And what I do at the end of the weekend is I go through all the charts, specifically the daily charts, and there are also some charts that are unique just to this video. And I pick out those charts that really aren't speaking to us that loudly right now, because we have to look deeper to see if we're getting any kind of clues from these other charts. Hence, that's the name Deep Dive Video. It might be a little bit different context than what you thought, especially if you're watching this for the first time. I like to explain that right off the bat because I like to be upfront with people about what I'm going through. This is being prepared for Monday, July 1st. I do have a program. It's called the SPX Investing Program. It has now launched. If you are interested in hearing more about this program, there are links below this video and every video that I post that will take you to videos on YouTube. There's a playlist there. You can learn more about the program. There's also a link that will take you to the website. I'm going to be locking it down starting July 1st. So you're kind of running out of time to look this over. But feel free to check this out and see if it's something that might be beneficial to you. The first chart that we're going to talk about is the VIX. Now, you don't see the VIX on here. It is invisible. Over top of that is a 50-period exponential moving average. We use this chart just for information. This is telling us over a period of time what is the general range of the VIX. Typically, when we're in really difficult markets or actually in a bear market, we see a lot higher VIX. When we're in a bull market, we see a lot lower VIX, and that's what we've been seeing lately. And I just like to look at this once a week or so just to let us know, okay. But I watch the VIX also every day, so it's not necessarily a surprise when I see things not really changing all that much on this chart. This is another chart of the VIX to see how fast is it moving, either higher or lower. To do that, I use an RSI based on 9 periods. We look for extreme positive or negative readings. Not getting one of those now. We're more or less neutral as far as how fast the VIX is moving. Then we look at the VIX and take a ratio of another indicator attached to the VIX called the VVIX, or the volatility of the VIX, and do a ratio between those. Generally, when this is going down with this ratio, the market's going up. When this is going up, the market is often going down. There are some exceptions along the way, but right now we are declining, and that is more positive. Then sometimes the VIX doesn't give us some real insight as to what's happening, so I use this other chart. This is a correlation between the VIX and the S&P 500. We really only pay attention to this chart when we get above this dashed line, and we're not above that right now, so I haven't been showing this chart. Then I was showing this a while ago. This is called the skew index. Now the VIX calculates using at the money options. The skew index looks at out of the money options. And when we get up into this red area, the market is expecting some kind of a big move. And recently we did get up into this red area. We haven't really moved all that much, at least to this point. And then we were able to drop down out of the red area. So we're not getting a signal right now, but I keep an eye on this every day, and I'll bring it up in the daily videos if we get back up into that red area. Then we look at the volatility of bonds, which is on top. That's measured by the MOVE index. The volatility of stocks is the next area down. That's the VIX. And then what I pay attention to is the correlation between the two. And we're seeing that volatility. Now, this doesn't measure price. This is just measuring volatility of stocks and bonds. They're having a tendency to go in opposite directions right now. Then we look at the VIX and the MOVE index again and do a ratio. What I pay attention to the most is typically when this red moving average is going down, that tends to be more positive. When this is going up, you can also see there are times when the market does go up and this line is going up as well. So we don't take this as a hard and fast rule, but typically when this is going down in this kind of an environment, it tends to be more positive. And we look at risk on versus risk off. Risk on means folks are jumping into the high beta stocks. That's the stocks that outperform when we're going up. Unfortunately, they also outperform on the way down, meaning they go down faster. And these are like NVIDIA, Microsoft, Google, Apple, the big names that everybody likes. And so when this is going up, that means more folks are getting into a risk on type posture, and that's usually positive for the market. When this is going down, the market is becoming more defensive. They're more risk off. They're getting into more conservative types of stocks because certain money managers and mutual funds, you have to stay invested all the time. You can't just go to cash or jump to a different market. You have to do what your prospectus says if you're a mutual fund, or what you is said that your ETF will do if you're managing things that way. So they get into a more defensive type of stance. Well, for most of 2024, we've been going lower a little bit here, but pretty much chopping sideways. So we just haven't been getting all that much insight from this particular chart. And we look at high beta stocks again. These are the stocks that outperform on the way up and on the way down, and compared to low beta. So it's a similar type of strategy. Not really seeing all that much. We were in a higher range for the earlier part of 2024. Now we've dropped down to a lower range, but we're not really seeing any breakouts either with this chart going up or down. Then we keep an eye on where are we in relation to the previous all-time high, which was set in early January 2022. As of Friday's close, we are up 13.32% above that previous all-time high. Then stockcharts.com has this thing called technical alerts, and they're automatically triggered. They look at the S&P, they look at sectors, they look at other indexes. They even have Canada in there. And we look at this to try to give us an idea, okay, are things more positive or negative? Now, these are the different alerts that were triggered for the whole week. Quite often, when we have a down day, you'll see lots of red. When we have an up day, you'll see blue or green, depending on what color you see. Friday was kind of interesting because we gapped higher and we were seeing all kinds of wonderful things to start off the day. Then everything reversed and turned negative, and now we start seeing lots of red happening here. We read this from the bottom up. This is the first signal that was generated on Monday, and then at the top is the last signal that was generated on Friday. Stockcharts.com also has this ability to do what's called technical scores. I use them with indexes. You can use these with stocks. You can use them with sectors, other indexes. Well, I mainly follow 5 indexes. The S&P is the foundation of everything that I do. And we also follow the Dow Jones as represented by the diamonds, the QQQs, which is the NASDAQ 100, the mid caps and the small caps. And then what stockcharts.com does is they try to remove the emotion from even looking at a chart. And technical analysis is supposed to remove the emotion already, but there's a lot of subjectivity in reading into charts. You can have different people all looking at the same chart and reach different conclusions. But this tries to remove as much emotion as possible and rates them on a score from 0 to 100. The higher the score, the better looking the chart. Coming in first place again, and this has been one of the stronger areas. It was stronger earlier in the year, then it dropped down. Now it's still looking pretty strong. Are the QQQs, which is the NASDAQ 100. And these are the big mega cap stocks, the Magnificent Seven, the stocks that everybody's talking about these days. And it comes in at 93.5. Now, my personal view is anything above 90, that's a good score. I don't really start getting all that interested if we're getting really low scores with this type of an approach. In second place, which also has a lot of the Magnificent Seven and mega caps in it, is the S&P 500, coming in just under 90 at 89. In third place is the Dow. Kind of been lagging a little bit, but did improve throughout the month of June, coming in at 55.7. And then in fourth place are the mid caps. And this had been a stronger area earlier in the year, but since it's really been pulling back and drifting lower, coming in at 48.3. And then in last place are the small caps, as represented by the IWM, which is the ETF for the Russell 2000 small caps. You can see the historical values over here, where this was giving us a score well under 20. We actually saw a bit of a bounce up in Friday's session. There was the rebalancing of the Russell 2000 index, and small caps had a pretty good day. And so that's where we saw a little bit of an improvement with the score here. And we have some short-term charts. This is a short-term rainbow. By short-term, I mean going from 10 periods up to 50 periods with moving averages. They're different colors, so it looks kind of cool. And even on a short-term basis, price is above all the moving averages, and the moving averages are going up. So the short-term trend continues to be positive. Then we look at another short-term indicator, and quite often this is in the daily videos. We had just come off of seeing an extreme positive reading. Now we're dropping back down with the down day that we saw on Friday. This is the Williams percent R, and it's pretty touchy. But for right now, it's giving us more of a neutral reading. We'll have to see if we get an extreme positive or negative reading very soon. Similar to that are a couple of other short-term indicators. The commodity channel index, or just known as CCI. Yeah, this was developed for commodities, but it works fairly well with stocks as well. And this had given us an extreme positive reading, and now it's starting to back off. Then I have a little bit longer term CCI here, dropping down after giving us an extreme positive reading. The boom indicator, this measures how far away is price either above or below a specific moving average. The top area is how far away are we from the 20 period, and then the 50 period and the 200 period. So we can use this like an oscillator. The reason why this is called the boom indicator is when we get really far away, we have a tendency to boom and go back and revert to the mean, so to speak, a mean reversion. And that's what this tries to measure. And we're not getting an extreme reading right now. In fact, we're falling down a little bit. We're not extreme with our distance to the 50, and we're not extreme distance away from the 200 either. Intermediate term rainbow goes from 50 periods up to 100 periods. Also seeing the lines having a tendency to go up and prices above all the lines. So the intermediate term trend is still positive. We look at a 50 period moving average. Now we're still above the 20 period moving average for right now. That's the short term in my definition. If we break below that, the next moving average that I'll be starting to follow is the 50 period. We're well above it right now, so I haven't been including this in the daily video. The same thing is true with the 100. If we break the 50, we really see more of a substantial decline at some point. Then the next area we'll be watching is the 100 period moving averages. This is the Carner's RSI, which is an oscillator. It gyrates around on a day in and day out basis. What we're looking for are extreme positive or negative readings, which we're not getting right now. This is a point and figure chart. This measures price, and it doesn't take time into account. So if it moves up or down by a certain amount, no matter how long it takes, if it goes up, it'll be an X. If it goes down, it'll be an O. We're still looking quite positive here. We didn't have any new X's or O's drawn this past week. We're still working off of a signal that was generated on May 15th of a double top breakout. And you can see just by looking at this overall chart, it's pretty positive currently. CMB composite, I also use this like an oscillator. We look for an extreme reading above the black line or below the black line. We're coming down, but we're more neutral right now in how I use this indicator. This is an anchored moving average, which is different than a regular moving average. Regular moving averages look at the current price and then calculate backwards. An anchored moving average, you go back to some kind of a high or low in the past, and then it projects that moving average going forward. We're way far above this anchored moving average going back to the previous all-time high, and all of the lines are going up, and so that's positive. I also have a couple of other anchored moving averages going back to the COVID lows. If we start to see some weakness at some point, then I'll probably break out and draw some other lines going from this previous high, these previous highs, to see if they end up providing support. Then we are well above the 200-day simple moving average. We're 12.22% as of Friday's close. Standard deviation, I was showing this chart for a while when we were coming up above the moving average. This doesn't measure direction. This just measures speed. And as we've been chopping sideways, the speed of the stock has just fallen off a cliff, and we're showing really low movement right now. Then we look at the S&P 100 on the bottom and compare it with the S&P 500 just to see if we're seeing any kind of negative divergences here. And the S&P 100 is still leading the S&P 500, and that's just meaning that the big stocks are leading the rest of the market. Then we're measuring from the October 2023 low and where we closed on Friday. We're up about 24.88% from that. Now, I measure this myself, so it might be a little bit different, but that's a pretty substantial gain since those October lows. Bollinger Bands, the way I use them on this chart is if we close above or below the upper or lower Bollinger Band. We did earlier as we were really moving up, but since then, we've been just going sideways, and so the percent B has been dropping off. It's declining, so you can see that as somewhat negative, but we're still above the midpoint, so you could see that as positive. The mass index is not generating a signal right now. We pay attention to this when it gets above the red dashed line or the solid blue line, and we're far away right now. Ichimoku cloud. These are moving averages that are placed on current price and then shifted forward. We use this as support when we've been going up and we see a pullback. Notice how we kind of fell right into the green cloud. And we're far away from the cloud right now, so I haven't been showing this chart. This is a full study with the Ichimoku cloud and a little bit shorter time frame, where we also see the green and the red clouds here, and we're above the clouds as well. So that's positive. But there are some additional measurements on here. There's a blue line and a red line. When the blue line is above the red line, that's more positive. And then we look at a longer term measure with the green line. And even though it declined on Friday, it is still going up overall. So this chart is still looking quite positive. Then we have a long-term rainbow going from 50 periods up to 250 periods. Just like the other charts, we're well above all the lines in the rainbow, and all the lines themselves are going up. So the long-term trend is positive. We look at a 10-day average of the S&P 500 highs minus the lows. This is a longer-term indicator. For most of 2024, we were pegged up here near the top, and that was suggesting good momentum. Sometimes we can use this like an oscillator for an extreme positive or negative reading. Typically in a positive environment like we've been in, we can stay up here for a long period of time. I haven't been showing this because we're not really at that extreme reading. We are looking okay. We're well above 50. So this is also still positive for right now. And we look at a special K chart. This is a long-term oscillator based on a daily chart. We're above the red line, and that is long-term positive. Then we look at a weekly chart of the S&P and a weekly chart of the DAX. They've been having some issues in Europe lately with some political uncertainty happening in France with their elections. And is France going to leave the EU and all of that? And so we typically will see a pretty high correlation between what's going on in the US and what's going on in Germany, which is the EU's biggest market. But lately it's been falling off as things have been holding up better in the US than they have been in Germany. Some support and resistance. I haven't been showing this chart. This is a 20-period simple moving average of the open, high, low, close. This creates its own little mini rainbow. We're well above the rainbow. All of the lines are going up, so we're looking positive. If we start to see more of a decline, sometimes one of these lines, in the short term anyway, may end up providing support. And then these are possible fib retracements. I did adjust this going back. We did set an all-time high intraday on Friday. We just ended up closing near the low. So I adjusted these fib retracement levels to see if we really start to decline. We're looking at these previous lows as not only support, but also as a 38.2% retracement level. Some broad market instruments here. This is the QQQs, and this is still looking solid. Even though we closed near the low on Friday, we're well above the 20, 50, and 200 period moving averages. This is the Vixen, where we use the VIX to look at the S&P 500. The Vixen looks at the NASDAQ 100, showing that volatility for the most part has been declining. The bank ETF finally was able to get above its 50-day moving average. There was a report this past week that there was a bank stress test, and the big banks that all took that test passed it. And so there was some positive follow through for the market on Friday. When we look at the regional banks, and that's what we've been keeping an eye on, like Silicon Valley Bank, Republic Bank, New York Community Bank, they have been really underperforming the financial sector itself. But we saw a little bit of a pop up on Friday as those stress test results were positive. Then I look at the S&P on top, and then a ratio between the Qs, which is the NASDAQ 100 and the Dow in the middle, and then the correlation between the two, and they're pretty much neutral right now. The transports have been very disappointing in 2024. That's the red line, where the Dow has been pretty much going up. The transports have been languishing and actually declining. And we look at U.S. stocks as represented by the SPY, which is the ETF for the S&P 500, and compare it with world stocks. And when this is going up, that means U.S. stocks are outperforming. Rate of change charts. These are just for information. Going back 250 periods, we're still looking pretty solid here. We're also looking fairly solid here. We're still below this blue line. We might get a little bit concerned if we go above this blue line, if we see another advance in the market. Just other times, and we can go higher than this blue line, but other times this would often mark where we're near some kind of an extreme reading. Looking at bonds, this is TIPS, which are Treasury inflation protected securities. That's what folks get into when they're worried about rising inflation and rising interest rates. That's when they outperform. Then we compare them to 3 to 7 year bonds. They're still outperforming because the market's really confused right now about what's actually happening with interest rates. We look at the long-term bond ETF, that's in blue, which has been going down. We look at the S&P 500, which pretty much has been going up, even though Friday was a down day. The longer-term correlation between these two is still pretty strong. The shorter-term correlation, it's improving a little bit, but they're actually not correlating with each other currently. And we look at the QQQs and then the long-term bond ETF here. They're still having a pretty strong tendency to correlate with each other. So they're usually going up or down. Now, this is the long-term bond based on price, not the yield. Then we have a weekly chart up here. We take the US 10-year yield and subtract the German 10-year yield. Since US rates are higher, that gives us a positive result. Then we look at the US dollar index in the middle area, and we see that there's a fairly strong correlation between the top chart, which deals with interest rates, and the US dollar index, which is also very heavily impacted by interest rates as well. So we kind of keep an eye on this to see if it's giving us any insight. Not necessarily all that breathtaking right now. We watch the yield curves. We're going on over 2 years now that the 10 to the 2 has been inverted. The 10 to the 3-month lagged. It went inverted a little bit later, but those are the top 2 areas here now, and we just still remain inverted with those yield curves. And then I have a number of things called possible positive scenarios. These were really helpful in 2022 when we spent a lot of time going down, and it looked like maybe we were bottoming and we could bounce up out of that, at least in the short term. Well, some of those charts are also very helpful, and I use those in the daily videos. The other charts are what I show here. This is the percent of stocks in the S&P above their 200-day simple moving average. Now, I have another study in the daily video that I look at each day. This one tries to track things more like an oscillator, where we look for an extreme positive or negative reading. We're not getting one, and we're above 50, so that is also still positive. We do that same basic idea approach with the S&P 500 with those stocks above their 50-day moving average. We're just barely above 50. We're coming in at 51. Also using this like an oscillator, which is not really helping us that much now. We keep an eye on the mid caps, which are actually dropping down below 50. I guess they're right at 50. It's really, is that 50? Yeah, they're right at 50 right now, but not really showing the strength that we saw earlier on in 2024. And then the small caps also a little bit below 50 right now. And then we keep an eye on the 2-year treasury yield. Sometimes when the 2-year yield spikes up and then starts to come down, that will often give short to intermediate term support to the S&P. We're not really seeing anything like that right now. Thank you. I really hope you found this helpful. I will be preparing another video after this called the What to Watch video, where the video you just saw goes over the charts that I'm not really looking at, or I'm looking at them, but they're not really telling us much. Where the What to Watch video, that goes through the charts that I'm really focusing in on currently. So have a great weekend, and I will talk to you in the next video.